Well, it was certainly a dovish tilt in the language of the latest minutes. Fed officials acknowledging that although the economy has taken steps in the right direction, the current conditions do not yet justify a rate increase. So this really reinforces the idea that the status quo is not good enough, that the Fed will remain on the sideline waiting for further improvement. And also on the inflation front, I found it very interesting that Fed officials now objecting to the notion that inflation is in fact reversing course back towards that 2% target. So you couple that with what's happening in the commodities market, stagnant wage pressures, and this actually reinforces our long-held forecast that the Fed will wait beyond that September meeting, beyond that December meeting, and really make a liftoff a 2016 event. We've maintained that 2016 liftoff a call for quite some time, and I think these minutes reinforce that notion.
I think today really shows us that data dependence is not a monetary policy. I mean, the data goes one way, it goes the other way. You know, my sense is that this is a committee that wants to hike. I haven't seen every word in the minutes, but certainly the fact that apparently the staff was actually going through options for the balance sheet adjustment, which will follow the first hike, if anything, tells me that maybe the odds of September have gone up. So it's a little bit of a puzzling reaction. Certainly they didn't take it off the table. You'd have to infer maybe the markets were looking for something in neon. Yes, we're going to hike. We didn't get that.
Data dependence is not a monetary policy. Flush that out. What's wrong with it?
Well, the problem with it is you always get data. What we need to know and what the bond and stock markets need to know is how will the Fed take that data and translate it into policy. They haven't really told us. What they've said is they're looking at a lot of data and eventually will hike. But what you really need is a reaction function. You need a mapping from the data to rates, and we don't have that with this Fed.
Did you correct?
Yeah, well, looking at the price to book, it's trading at about half the price to book of the U.S. marketplace. You know, if you look at what's happened just over the last year with the government pension plan reallocating, doubling their exposure to Japanese equities, you have Japan Post likely to follow suit in terms of increasing its equities. So the demand's there for Japanese equities. Valuations are strong. Earnings are really strong this season. I like Japan.
You think there's room for a run in our market between now and the end of the year? Or are there just too many things going on?
No, I think that, you know, we have to manage investor expectations. I think we could see a slow advance, single-digit advance between now and the end of the year. But some of this volatility creates opportunity, more attractive entry points.